You feel that familiar sting of regret. A story catches fire, a new technology, a revolutionary discovery, and you hesitate. You tell yourself it's just noise. Then the stock begins to move. Slowly at first, then with an undeniable force. You watch it climb day after day, a silent testament to your inaction. The crowd is euphoric. The experts on television declare a new paradigm, a fundamental shift that makes old valuation metrics obsolete. This time, they whisper, and then they shout, is different. And in a moment of weakness, overwhelmed by the fear of missing out, you finally buy. You buy near the top of a parabolic rise, just as the last of the uninformed public rushes in, seeking easy profits. For a day, perhaps a week, you feel the thrill of victory. Then the character of the market action changes. The ascent stalls, the volume churns, but the price goes nowhere. And then the floor gives way. Your small profit vanishes, replaced by a growing, sickening loss. You hold on, telling yourself it's just a pullback, a healthy correction. But the market does not listen to your hopes. It continues its descent, erasing months of gains in a matter of days. You're left holding a stock that is now a fraction of its peak value, a monument to a lesson as old as the markets themselves. The four most expensive words in the English language are, "This time is different." The human mind is a poor instrument for speculation. It is wired for narrative, for stories, for hope. We are drawn to novelty. We want to believe we are living in a special time, that the old rules no longer apply. This is a weakness the market exploits with surgical precision. Every great speculative bubble in history, from the South Sea Company to the railroad manias of the 19th century, was built on this foundation of novelty. The narrative is always the same. A new technology, a new resource, a new world order has arrived that will create unprecedented and unending prosperity. The crowd, intoxicated by this story, abandons all discipline. They forget that the market is a machine that processes human emotion, and the primary emotions it processes are greed and fear. These emotions have not changed in 1,000 years. The technology that delivers the price quotes may change, from a ticker tape machine to a glowing terminal on your desk, but the human heart that reacts to those quotes is immutable. The patterns you see on the chart are not random squiggles. They are the footprints of human nature. They are the visual record of a timeless battle between hope and fear, greed and prudence. When you believe, "This time is different," you are betting against the entire recorded history of human behavior. It is a bet you are statistically guaranteed to lose over the long run. The market cycle is not a technical phenomenon. It is a psychological one. It begins in skepticism, grows in optimism, matures in euphoria, and dies in despair. To ignore this cycle is to walk willingly into a trap set centuries ago. Let me take you back to a time when steel was the new technology, the engine of a new industrial age. Consider the story of Anaconda Copper in the early 1900s. Copper was not merely a metal, it was the lifeblood of electrification. It was the material that would wire the world for light and power. A powerful narrative began to form. Demand, the story went, was insatiable and permanent. The invention of the automobile, the expansion of the electrical grid, the needs of a world preparing for a great war, it all pointed to a future where copper prices could only go higher. The stock of Anaconda, one of the world's largest producers, began its quiet ascent. For months it built a solid base, what we would call an accumulation phase. The big money, the patient and informed operators, were absorbing shares from weaker hands. The news was still mixed, the public was not yet interested. Then the stock crossed a pivotal point. It broke out of its range on heavy volume. The tape came alive. The story began to spread. Newspapers wrote breathless articles about the copper kings and the dawn of the electric age. Small-time speculators who had previously paid no mind to industrial metals were suddenly experts. They talked about it on street corners, in barber shops, and over dinner. They saw Anaconda stock rising day after day and felt the pull of easy money. The stock was no longer trading on fundamentals. It was trading on pure emotion. It became a public spectacle. The advance accelerated, turning parabolic. Any small dip was instantly bought. The crowd felt invincible. They mistook a bull market for their own genius. At the very peak, the volume was enormous, but the price made little upward progress. It was churning. This was the sign. This was the moment of distribution. The same insiders who had accumulated the stock patiently at the bottom were now feeding their shares to a greedy and unsuspecting public at the top. They were selling not because the story of copper had changed, but because the market action told them the move was exhausted. Then the break came. It was sharp and violent. The public who had bought on hope now held on with that same hope, believing it was a temporary shakeout. But the smart money was gone. There were no more buyers to support the price. The line of least resistance was now down. The descent was far more rapid than the ascent, as fear is a much more powerful motivator than greed. Fortunes built over a year of euphoric buying were wiped out in a matter of weeks. The public was left with heavy losses and a worthless story. The cycle was complete. It was not different. It was the same old story, just with a different name. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk a dollar of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. I teach you the psychology of the market, the discipline, the mindset. I explain the why behind the price movements, the unchanging human emotions that drive these cycles of boom and bust. But for the precise mechanics, for identifying the exact moment of accumulation, for knowing where to place your stop, for understanding when the distribution is complete, you need a structured method. You need to see the footprints of the large operators as they leave them on the tape. That is the science of market mechanics. I give you the discipline and the mindset. But for the precise mechanics, exactly where, how, and when to execute the trade, you need the structure of Richard Wyckoff. He codified these patterns of accumulation and distribution into a repeatable, logical framework. I have left the link to his channel in the description below. Use it to complete your arsenal. Combine my lessons on psychological discipline with his methods for technical execution. That is how you become a complete operator. Now, how does this cycle manifest today on your screens? The names change, the sectors rotate, but the pattern is eternal. Let us consider something as seemingly mundane as the railroad sector. A new international trade agreement is signed, or a breakthrough in automated logistics makes rail transport dramatically more efficient. A narrative begins to build. Rail is back, the headlines proclaim. A renaissance in physical transport. You will see it on the chart before you read it in the news. You will notice a major railroad stock, perhaps one like Union Pacific or CSX, that has been dormant for a long time, suddenly showing signs of life. The first signal is a subtle increase in volume during a quiet basing period. The price is not moving much, but the turnover is increasing. This is the quiet accumulation, the smart money taking positions. Your job is not to buy yet. Your job is to watch and wait. Then comes the breakout. The stock moves above a long-term resistance level. It does so with a burst of volume that is several times the daily average. This is your first potential entry point. The risk is defined. Your stop loss goes just below the breakout level. Now, the public starts to notice. The story hits the financial news networks. Analysts upgrade their ratings. The stock begins its steady advance, the markup phase. Your task here is the most difficult of all. To sit tight. You do nothing. You let your profits run. The crowd grows more excited. You will see the angle of ascent steepen. The daily price swings will become wider, more volatile. This is a sign of late-stage speculation. Amateurs are piling in, chasing the price higher. Now you must be on high alert. You are looking for the climax. This often comes in the form of a climactic run, a day or a week of the largest price gains and the heaviest volume of the entire trend. The stock may gap up at the open. The euphoria is palpable. This is not a time to buy more. This is the time to prepare your exit. This is the moment the insiders are selling to the crowd. Following this climactic action, you will see churning. The price will swing wildly but make no net upward progress. Volume remains huge. This is distribution. The stock is being transferred from strong hands to weak hands. Once you see a clear break of the upward trend line, or a failure to make a new high after a pullback, the game is over. You must sell your position. You do not wait for it to come back. You do not listen to the stories anymore. You listen only to the market action. The tape has told you the great move is finished. What happens if you make a mistake? What if you are the one who buys at the top, caught up in the euphoric story? The first and most critical action is to admit your error immediately. The market has told you that you are wrong. Do not argue with it. Do not hope. Hope is the enemy of a sound trading account. You must have a predetermined stop loss for every single trade. The moment that price is hit, you exit the position. There is no negotiation, no hesitation. The loss is small and manageable. You preserve your capital to trade another day. The novice holds on, praying for a recovery. The professional takes the small loss and moves on. The initial loss is always the smallest loss. By holding on, you turn a tactical trading error into a devastating strategic blunder. You tie up your capital in a dead-end position while new opportunities are passing you by. And worse, you damage your own psychology, anchoring yourself to a losing trade that drains your mental energy. Now consider the opposite scenario. You correctly identified the trend, you bought near the breakout, and you sold after the first signs of distribution. But the stock, after a brief pause, makes one final frantic push higher. You are in cash, watching from the sidelines as it adds another 10 or 15%. The feeling is agonizing. You feel foolish. The temptation to jump back in is immense. This is where discipline is forged. You must recognize this final surge for what it is. The last gasp of a dying trend, driven by the most uninformed and emotional segment of the public. It is the greater fool phase of the market, where people are buying for no other reason than the fact that the price is going up. Re-entering here is a low-probability, high-risk proposition. You followed your plan. You locked in a substantial profit. You must be content with that. No one ever went broke taking a profit. The goal is not to catch the exact top and bottom of every move. That is an impossible fantasy. The goal is consistent profitability over the long term, and that is achieved by following a sound method, not by chasing the last eighth of a point in a speculative frenzy. Let the latecomers fight over the scraps. You are already looking for the next opportunity, the next cycle that is just beginning its quiet accumulation phase. The patterns of the past are not simply historical curiosities. They are a roadmap. They are a warning. The market has a long memory, even if its participants do not. Every speculative excess is punished. Every bubble eventually finds its pin. The names on the ticker will change. The industries will rise and fall. The stories will be new and seductive. But the underlying structure of the market cycle, rooted as it is in the unchanging bedrock of human psychology, will remain. Your task is not to predict when the next mania will occur or what story will ignite it. Your task is to study the cycles of the past so deeply that you recognize the pattern when it appears before you in the present. You must learn to distinguish the quiet footsteps of accumulation from the deafening roar of public euphoria. You must cultivate the patience to wait for the proper moment to act and the courage to sell when the tape tells you the move is over. Even when the crowd is screaming for more, the market is a current. You do not fight it. You do not argue with it. You study its tides, respect its power, and align yourself with its primary force. That is the path to survival and ultimately to mastery. Stay disciplined.